Good morning, MMTs. It's 11:28 a.m. It's Sunday. It's 3/20/2011, and it just so happens to be our very favorite day of the week. Some of the MMTs are here today because there was no MMT manager scheduled. The ones that showed up are getting a special gift. What we're going to be looking at as making a market on QCOM with the equity is how you're going to grow into the process of trading either the $50 put wholesale and buying the $50 call, going long the equity and short the equity using that component and this component. And as we teach you newer MMTs how to make the intraday market maker spread long and short, is how do I know what to do over here with the $50 call? And how do I know what to do with the $50 put relative to everything on the other videos that we did today with QCOM? Is how do I make a market with QCOM? And this is the MMT platform in here, but we've already went over all the charts. And basically when we do a drop down bid, this side loses premium. What it means is that the market makers here that are lined disappear and they see lower price levels down here. So let's say they disappear 297, 296, and 295, but the next print they may see may be $1.80. That's when that lower end of the actual equity price will hit the bottom. When it bounces, when it will bounce intraday, QCOM likes to bounce intraday, 3 minute. This is a daily, but I'm just showing you. On the daily chart, if the gap, the left elbow gap down, they're going to immediately and manipulatively, in the price action, manipulate and walk away from here and create a much lower print price in the call. And the people that own them will sell to them. Once they sell to them and they get that lower bid and we bounce off that lower market maker price delta action line to the upside, we get value going back up and they sell in that market. That's one thing. The other thing is the opposite on the put side of the trade, which is right here. So let's get QCOM out of the way there and let's put the put here. Now let's go back to let's say another QCOM 3 minute chart. Okay, and this is what we were doing on Friday. Okay, now watch that when the put side over here, QCOM put, when they shorted that longer move down to the bottom, that's where the lower end of this put option hit $1.03 on triple witch options expiration Friday, and then they had a spread there. So as they sold short down the equity here, the premium on the put side has less price action volatility than the actual call side. It's wider ranges over here in this market and more of a contractual number in this market within the actual spread. So when we got to the bottom, that means that the put had put the high in. When they started to walk that dog, that meant that that low was put in. And when they got the low put in, they walked it all the way up there. They got from 249 up to 405 as a high. So you can see the price spread here with that directional movement within the yield structure. That's called the price action, 2.49 ratio to 4.05 ratio, subtract the 2. That's your net ratio from the bottom to the top. Now, when we got to the top, the call got to the top. But in order to get that call price to 249, they had to short that equity down. So that side of the market makes the high. This side of the market makes the low. What you're going to learn is that you're going to be buying QCOM intraday here, and you're going to be buying that low here, and that put option is going to come down in value, and you're going to watch this one go up in value, and it's going to be based on this 3 minute chart price action with the market makers and how they walk that dog up. So I steal here to get the bottom here. After they steal here, you get the dollar, whatever it is. Let's call it $1.50 lower in the spread. Then you buy, they buy the spread, they walk away, they get people to sell it. You take possession of their purchase at the low end of the call. Then when we move up, the call value goes up, the put value goes down. The farther that we walk it all the way up intraday is the longer term value of the call that will happen. Now, the differences in the options market, MMTs, is that it's not like it was for all, even the biggest professionals haven't even figured it out, let alone the general public usually can't figure it out, sometimes never, maybe 2 or 3 years have to go by. They still in both sides of the premium side of the markets, long and short. And basically, when you do get wholesale over here, in the old days, if I got wholesale at $2.49, this would have went up to $6. But they're diminishing the price action spread to the high when this move is occurring there on the call side versus the put side. So when the put side, when the short side of the equity is, you know, in your market maker platform, everything that we do here that is going straight down, that's when that value is going up here from the low back up to here. So the low was $1.03. So when they shorted it down, they got that wholesale entry and then they sold there. You're going to learn to master. Call side. Short side down, the closing price, let's see what the previous day's close was. $3.70, my friend. But notice that the wholesale bid was 2.49. You see that spread from here to there? Now let's go back to the 3-minute chart, MMT. Is that when that move was happening, you're looking for the high side here and the low side here. They're going to steal here to buy because the short side is going to take the premium out of the $50 call to the wholesale market maker bid. Once the bottom gets in and the market makers start to walk that, and you know exactly, MMTs, how that's going to work. That's when you're buying here to gain value, and this side is going to support that side. When this side's dropping in value, this side is putting in a bottom and it's going to move up. And you're going to learn to make the market long and short with the equity, but you're also going to have your level 2 $50 put and $50 call open right along with the equity price so that you can get the correct wholesale yin and yang. And what it means to be a market maker in the equity side and what it means to be able to trade the $50 put and the $50 call. If I've got an understanding the entry mechanisms or the entries and the gimmicks that go in these markets with the market makers in the option pit and the market makers in the equity pit. They're two different pits. They're two different set of market makers, but one hand feeds the other. And the thing about it is on that level, you're going to learn that consistently and repetitiously of learning to make the market here as a market maker is also going to put you in making markets on both long and short here. Now, having said that, I'm going to go to the next thing. I'm going to move the $50 call over here. I'm going to move the $50 put, and I'm going to show you right now in the very same video the difference between that market makers can short options down just like you can short a stock. Public don't know that. So basically over here you were very deflated at the $50 put when QCOM was much higher than $50. And at the time the $50 call was putting in the top when the actual, and this is a daily chart here. So let me do one thing. Let me kind of blow this up for you so you can see where the bottoms were clearly here. Now, MMTs. Here's the deal. When QCOM was much higher than $50, these put options on the other side of the trade for them is to get this side of the market at the most deflated price that they can. The low was 24 cents. So if I bought 100 contracts at a quarter, that's a $2,500 investment. Now, when this chart here on the call side, this is the call chart, MMT, when this call was putting that top in, this put was putting that bottom in. This is the wholesale deflated price. You have to learn that SMF teaches you how to buy this side of the market because it's the cheapest side of the market. Now, when that bottom was put in, this was the true side to get on. Because these calls over here that's in this video right here for you, $50 call was extremely inflated. So as they took those down, look at the amount of dollars. They took them down almost $8 from the high here. Let's see what the high was. The high in the $50 call was $10.05. And this is this previous expiration. That's why I'm using this chart. But we will, in the next video, go to the 516 chart, which is the next option's expiration. The high was $10.05.